Hello and welcome to the Personal Finance Time Update for the United States. July 2025 brought some encouraging news. Inflation is finally near target levels and the Federal Reserve hit the pause button on interest rate hikes. We'll break down what that means for your wallet, from prices at the store to interest rates on your savings and loans, and sprinkle in some Gen Z trends and a dash of humor along the way. Inflation nearing the comfort zone. After a couple of years of high prices giving everyone sticker shock, inflation is cooling off in the US. In fact, the Fed's preferred inflation gauge showed prices up about 2.7% as of June, just a tad above the Fed's 2% goal. For context, that's a dramatic improvement from the surging inflation we saw in 2022. What's behind this relief? Energy prices steadied, supply chains improved, and consumers became a bit more strategic in their spending. Yes, even girl dinner, frugal trends on TikTok might be helping. Moderating inflation gave the Fed some breathing room, suggesting we may be past the days of runaway price hikes. As one report put it, the latest data validates the Fed's decision to keep rates unchanged. More on that next. Federal Reserve holds rates. What it means. The Federal Reserve decided not to raise interest rates in its late July meeting, marking the 7th consecutive meeting with no change. In plain English, the Fed took a summer vacation from hiking rates, largely because the economy is giving mixed signals of stability. Job growth is solid, about 147,000 new jobs in June, beating expectations, and unemployment is low at approximately 4.2%. That strong job market, coupled with cooling inflation, meant the Fed didn't feel a need for more rate moves right now. In fact, two Fed governors even wanted a rate cut, the first such dissent in decades, though the majority voted to hold steady. For everyday Americans, the Fed's pause has a few effects. Borrowing remains pricey. Interest rates are still high by historical standards, so loans haven't gotten cheaper yet. The average 30-year mortgage is around 7% and credit card APRs top 20%. Ouch. That means buying a home or carrying credit card debt is expensive. Many prospective homebuyers are pressing pause on moves, waiting for lower rates. And if you have credit card balances, it's a smart time to aggressively pay down high-interest debt to avoid those hefty interest charges. As Bankrates analysts put it, those with less debt and more savings will be best positioned to weather whatever comes next. Savings accounts shine. Here's the upside: savers are finally winning. With the Fed holding rates high, those high-yield savings accounts are still offering interest we haven't seen in over a decade. It's common to find savings accounts yielding 4.1% CENT, 4.3% APY, and even short-term CDs around 4.5%. That means your cash is earning money again, effectively outpacing inflation. In other words, a dollar saved today might actually be worth more tomorrow, not less. Funny how that was unheard of a couple years ago. So Gen Z and millennials, notorious for keeping money in Venmo or Cash apps, are now moving extra funds into these high-interest savings for some risk-free returns. Cost of living and consumer trends. Even with inflation cooling, the cost of living remains a hot topic. Prices are higher than they were pre-pandemic, and essentials like housing are still a pain point. The median U.S. home price hit about $435,300 in June 2025, a record high. Combined with mortgage rates near 7%, it's no surprise first-time buyers feel squeezed. In fact, many Americans are finding owning a car or home increasingly tough. A recent report highlighted a troubling car loan trend. Over 1 in 4 consumers owe more on their car loan than the car is worth, and a whopping share of car owners now have $1,000 plus monthly payments. Let that sink in. Some people's car payment is as high as a rent. It's a sign that easy credit and pricey vehicles are putting folks underwater on loans, and it's causing many to rethink those big-ticket purchases. On a brighter note, Americans are adapting and finding creative ways to stretch their dollars. Gen Z and young adults are hustling. Many picked up side gigs or tightened budgets as living costs climbed. A Bank of America survey found 72% of young adults have taken action to improve their finances as costs rose, whether by cutting discretionary spending or seeking higher-paying jobs. Meanwhile, the personal finance conversation on social media is booming. On TikTok, hashtags like #DebtFreeJourney, 115 million views, and #PassiveIncome, 90 million views, are trending, as young people swap tips on paying off debt and earning money online. It's practically cool to talk about saving money and investing now. Who would have thought budgeting could go viral? Fintech and innovations. This generational shift is aided by fintech innovations. In July, the digital finance world kept evolving. More users embraced budgeting apps, investing platforms, and payment services. We're seeing continued growth in everything from buy now, pay later services to AI-powered financial advisors. Yes, robo-advisors might be your next money manager. Traditional banks are also upping their tech game, with some even partnering with fintech firms to improve offerings. On the crypto side, the summer rally in Bitcoin and Ethereum had crypto enthusiasts excited. Gen Z loves a good crypto comeback story. And speaking of trending fintech, there's even chatter that GPT-5 and advanced AI could transform personal finance soon. But that's a topic for another day. The key point: technology is making it easier for younger Americans to track spending, automate savings, and learn about investing, all from their smartphones. Storytime. A summer of financial learning. Let's illustrate these trends with a little storytelling. Meet Ava, a 24-year-old recent college grad. Ava noticed her grocery bill stopped ballooning this summer. Those eggs and milk are no longer breaking the bank each week. That's the 2.7% inflation reality setting in. Prices are still rising, but much slower than before. Encouraged, Ava decides this is the year to get her finances in shape. She's carrying some credit card debt, from spontaneous road trips and a too-good-to-resist shoe sale, so she commits to a debt-free journey. She even posts about it with the hashtag debt-free journey, gaining encouragement from others doing the same. Ava also opened a high-yield savings account for an emergency fund. Earning approximately 4.3% interest feels like a small win. Free money, just for saving? Yes, please. She jokes that her savings account is now her favorite subscription, paying her each month instead of the other way around. Ava dreams of moving out of her rental and buying a home someday. But when she checks mortgage calculators, the monthly payment on a starter home is sky high. With 7% mortgage rates, she'd be paying almost double what a similar loan would have cost a few years ago. And hearing that some people pay $1,000 plus for cars, she wisely decides her perfectly functional 2014 Honda can last a bit longer. No luxury SUV in her near future. Instead, Ava puts a bit of money into her 401k and a low-cost index fund. She's learned from TikTok investors and online forums that time in the market beats timing the market. Light humor and insight. There's a silver lining in all this. After years of financial chaos, Americans are regaining a sense of control. We're seeing something of a personal finance renaissance among young people. Instead of YOLOing on meme stocks or crypto moonshots, more folks are budgeting, investing prudently, and pushing for raises to match living costs. Even memes reflect this, like one joking, "Went to Target for toothpaste, left with my retirement plan contributions maxed out." It's funny because it's true, budgeting is in. And with inflation finally behaving, maybe we can joke that $5 gas and $10 eggs are so last year. Now if only housing and college costs would chill out too, we'd really be in business. The road ahead. As July 2025 closes, the U.S. economy seems to be at a hopeful juncture. Recession fears have eased, unemployment is low, and inflation is almost tamed. The big question: will the Fed start cutting interest rates later in the year? Some experts think a small cut by late 2025 could happen if inflation stays around 2-3%. But Fed Chair Jerome Powell has made it clear they'll wait and see before any cuts. In the meantime, consumers should stay cautious. High rates aren't disappearing overnight. Now is the time to pay off expensive debts, lock in fixed-rate loans if needed, and keep building that savings cushion. As one analyst quipped, interest rates are high and unlikely to drop quickly, so lean into it by paying down debt and padding savings. Solid advice. And remember, personal finance is a marathon, not a sprint. This month taught us that conditions can improve. Who knew we'd be celebrating 2.7% inflation and 5% savings yields in the same breath? The key is to stay informed and adaptable. Speaking of staying informed, like, share, and subscribe for your monthly dose of money news, fast and clear. Do not forget to visit personalfinancetime.com.